All right, this is the solution for Blackboard assignment number 2. And we've got question 1, part A, and part B, and question 2. So let's jump into part A. So part A is journal entries to record all the transactions. No entries been required. There may be some entries that are required on a date mentioned or not be required, so you needed to do a memo entry in that case. But let's go through these one at a time and just see. Now we know the way we start on this is the sort of the opening balance here, the opening values. For common shares was 129,000, and for common shares was 13,000. And so that's great. This is in dollars, so we're just going to format that just so you can see that it's dollars. And this one is, and we'll just reduce the size a little. And then this one is just in shares, and again, we'll reduce the size and make them fit. All right. So our first entry here is to issue some common shares. So this one is on January the 8th. And we end up, question says that we split the common shares 3 for 1. Well, that's just a memo entry in that case, and put something like stock split 3 to 1, something like that. That should create 26,000 more common shares for you. January the 29th, we issue 5,000 common shares at $5 a share. So that should be $25,000. So our entry is to debit cash for the $25,000, and then on common shares, we have the credit as well for $25,000. And let's make this all dollars as well, so it's easy to see. And we'll reduce that. Sounds good. Now this one is a common share entry, so we've got to add this over here. So 25,000, and it's 5,000 shares. Okay, that's good. Next one is declare a cash dividend. The dividend is in total 150,000, and we've got to split it between the pref and the common shares. So on the total dividend itself, because it's dividend, and this is February the 1st, we'll put it on there first of all. You charge that to retained earnings. Any dividend you're going to charge to retained earnings. And so that's going to be 150,000. That's a debit to retained earnings of 150,000. And then we've got dividend payable. Dividend payable for the preferred shares. And we've got dividend payable on the common shares. And we need to find out exactly who gets what. So those preferred shares are in arrears. If you add it up, it's 4 years worth of preferred dividends that we need to pay, being 2018, 2019, 2020, and 2021, because we now are in 2021. So 4 years times, we're supposed to pay $3, $3 per share per year times 8,500 shares. So that should be $3 times 8,500 shares times 4 years. That's 102,000. So the difference between those two is what's left over for the preferred shareholders, which should be $48,000. So that's from the date of declaration. We've got more that's coming up here. So on February the 4th is the date of, and again, it's just a memo entry. Date of record for February 1 dividend. Okay, so that's good there. And then on February the 10th, we actually pay that dividend. So in that case, we've got to get rid of these dividends payable. So we'll get rid of them here. In order to do that, we need to debit them for whatever the amount that we credited them. So that's fine. and then we're going to spend cash doing that. So that's the 150,000 in cash going out the door. Okay, we're on to February the 18th. We've repurchased 10,000 common shares at $2.80 a share. Okay, so February the 18th, we've repurchased, so we will have spent cash. We repurchased some common shares, and we're going to do the calculations in a minute. And we're going to credit cash for whatever we had to pay. Now the cash in this case was, let's see, we had to pay it was 10,000 shares times $2.80 a share. That should be $28,000 worth of cash. Now, if we look here and determine what the average issue price is here, because that's the key in this one, the average issue price. Oops, daisy. So we know that in total shares that we have outstanding here, we have, let's just add it up and just see. So the total shares, add these things up, we should have 13, 26, and 5, 44,000. And then in terms of dollar values, we've got 25,000 that we got here, and then we started with 129,000. So 154,000 in value, 44,000 shares. So the average issue price is the one divided by the other, which is $3.50. So we sold 10,000 shares, or sorry, redeemed or repurchased 10,000 common shares. And so that's, and I got the 28,000 in the wrong spot here, but there we go. That's the credit to there. And so our common shares, this number should be the 10,000 shares times the average issue price, which is $3.50, or 35,000. That's right. And the difference here goes to that contributed surplus share repurchase account, and that should be $7,000. Good. Then the next one we've got here is February the 27th, and that's declaring the stock dividend, which is, oh, and here we better catch this. So we just took out 35,000 shares and $35,000 and 10,000 shares. So we're down here now. The number of shares we have left is 34,000. So when we have our 15% stock dividend, then what we've got to do is, again, it's dividend, so retained earnings is what we charge. And it's a 15% stock dividend, so the amount of the dividend is going to be the 34,000 shares that we have times 15% times the market price, which in this case is $4.50 a share. So if we do the math in there, so it's 34,000 times 0.15 times 4.5, 22,950. And this is this funny account, common stock dividends distributable. There you go. And it's 22,950. And then March the 8th is another memo entry for the date of record of the stock dividend. So date of record for February 27th stock dividend. There we go. And then we actually issue the shares. So March 17th, March 17th, we clear out this common stock dividends distributable, which is the 22,950, and we actually issue the common stock or common shares for 22,950. And when we do that, that impacts this column over here for dollars, and in this case for the number of shares. And so the number of shares we figured out was 15% of 34,000 up here. So 34,000 times 0.15 is the number of shares that we have, equals 34,000 times 0.15, 5,100 shares. And then finally we get to the one more repurchase, so that's March the 19th. So March the 19th. We're going to repurchase some shares, so we are definitely going to debit common shares, and that's going to cost us cash, we know, so that's fine. And we know the cash, the amount of the cash they tell us is we're buying 15,000 shares at $4.75 a share. So the cash coming out of our bank account should be 15,000 times 4.75, 71,250. And here we've got to recalculate the average issue price. So if we do that, then how much in dollar value we have 22,950 plus what we had up here, which was the 35 that we just spent, plus the 154. So we're at 141,950. And the number of shares then is going to be those 5,100 that we just gave out, the 10 that we repurchased, and the 44 that we had in our previous calculations. So the average issue price is going to be the dollar value divided by the number of shares outstanding, which is $3.63. So we're going to redeem 15,000 shares, so that should be 15,000 at $3.63 a share. If we do the math, equals 15,000 times 3.63, 54,450. Got to make this balance. So first and foremost, we get rid of this. We use the contributed surplus share repurchase account here that has $7,000 in it, and we clear it out. That's the first thing we do, just get rid of it. We still need some more. We need to get rid of the rest of it to make it balance. We charge that to retained earnings. So the difference between that is going to be that minus that, which should be $9,800. So that's all the journal entries on that one. Let's have a look at that statement of equity then. So we make sure that you caught that it was the quarter ended March 31st, or you could have had the 3 months ended March 31st, but regardless, you needed to have that in there. Then on the issuance of shares, we just had the one issuance there for 25,000. So that'll shoot over here as well to add 25,000 to total shareholders' equity. On the repurchase of shares, we actually had a couple. And the grand total you're going to find is 89,450. And that would actually reduce the amount of common shares by that. And we had some stuff through this account, but it ended up being zero in the end. But on that last entry, there's a $9,800 debit to retained earnings. So your total amount here, impact on the shareholders' equity accounts, are $99,250. Then we had a cash dividend, and it was $150,000. And remember, dividends reduce retained earnings, so that needs to come out of there. The stock dividend that we did was $22,950. It created $22,950 in common shares, and because it's a dividend, it has to come out of the retained earnings number. So it doesn't have any impact on the total. It's just shuffling between the two. And then the net income was $85,000, and so that'll increase the total shareholders' equity by $85,000. So you needed to have these totals at the bottom here. You need to have the date right, and you have the right entries in each one of these things here. And that was the second part of that question. The earnings per share question was a good one. So on this one, you needed to know what the formula was, which is going to be the net income less any preferred dividends. And because they're cumulative, you've got to figure out that there are dividends there. So we expected that over the weighted average weighted average number of shares. That's your formula that you needed to have in there. So if you got that, you got a mark. And then the calculation is 350,000 in net income minus the pref dividends, which was 5,000. Sorry, pardon me. It was $1 times 5,000 shares. So you should have ended up with something like this. And the top number should have come to $345,000. Now the weighted average number took a little bit more work. So to do that, if you would have used the layout that we saw in the text, that would have worked really good. But the weighted average number of common shares. So the way we do that again is we look at, okay, how many shares did we have to begin with? Well, we had 9,000 shares. And for what period did we have those shares? Well, we had them from January until the end of February. So that's 2 months, or 2 12s. And if you did the math, sorry, let's do it this way. 2 divided by 12. Did the math, and we'll do it here. It should be 9,000 times 2 divided by 12, 1,500. So the next period that we had shares was from March the 1st to, in this case, it looks like it's July the 31st. So that's fine. And that would be March, April, May, June, July. So that's 5 months of 12. Let's do it this way, 5 of 12. And during that time, we had issued more shares. So we started with 9,000 and we issued 6,000 shares on March the 1st. So we should have 15,000 shares. And we'd have 15,000. Again, we just got to do the math. So that equals 15,000 times 5 divided by 12. Should be 62.50. Then we've got a change on August the 1st. And so August to, it looks like the end of October. So because something changes November the 1st. So that's going to be August, September, October. That's 3 months of 12. And what happens? Well, we repurchase 1,700. So we should have 1,700 less. So that's 13,300 shares. And again, do the math, and that'll be 13,300 times 3 divided by 12. Yeah. Let's try that again. So equals 13,300 times 3 divided by 12, 33.25. And for the last period, so that would be just for November and December, we know that we've issued another 4,700 shares during that time. So we add that back on, and now we're up to 18,000 shares, and that'll be for 2 of 12 months. And again, let's do the math. So equals 18,000 times 2 divided by 12, and that'll give you 3,000. Add those up, and I think you'll find that it's 14,075. And if you look at it, 14,000 shares, that's somewhere in the middle of all of this stuff. You bet that makes some sense just from a reasonableness perspective. And if I look at the rest of the calculation here, then that 14,075 can go there. Do the math, so you'd have 345,000 divided by 14,075, and let's get that to figure it out for us. $24.51. Well, and you should have said that there was a dollar sign in there. That's the earnings per share. And the last thing you needed to do, which was part B, easy mark, was to say which one you'd like to invest in. Dave's Diner makes $18.28 per share, and this makes $24.51. So you needed to say that you would invest in Bob's Burgers because the EPS is higher in Bob's Burgers. You needed to somehow show me that you actually understood what you were calculating. If you did that, that was the solution. Okay, hope that helped out there. Hope that made some sense to you.